Not all companies and their stocks are winners. In fact, some are losers, despite their lofty stock prices and valuation. By the time you're done watching this video, you'll know exactly which ones I'm thinking of, and you'll even know how to tell if a stock is overvalued. And in addition to that, I'll even drop some knowledge on the best way to invest in the stock market so you consistently make money. So, be sure to lovingly, tenderly, gently smash that like button for the YouTube algorithm, and let's get started. You're watching Finance Squared. I'm your host, Derek West, and not all stocks are created equal. In fact, some really stink and probably should be avoided. Let's start by looking at how you can tell if a stock or another asset is overvalued. To understand why some stocks are overvalued, we need to understand some financial geek speak, so to speak. That is, metrics about companies and their stocks, and look at how to apply those metrics in an analytical way to help us evaluate a stock's potential. That's called fundamental analysis. And in all honesty, that is a video topic all on its very own. In fact, I may have a video on this very channel that I uploaded, so check it out in the video card above. But for the sake of brevity, we'll only go over a couple of metrics and how to apply those to stocks to tell if they're overvalued or not. PEG, price earnings to growth ratio. This metric is a metric which is calculated by taking the price to earning ratio and dividing it by the forecasted growth ratio of its earnings for a specific period of time. PE, commonly referred to price to earnings ratio. What is that? Well, that is a ratio that measures a stock's current share price ratio relative to its earning per share. A high PE ratio could mean that a stock is overvalued. It also can mean that investors are expecting high growth rates in the future. A good thing about this metric is that if a company is losing money, then the PE ratio is effectively non-existent. This means if you're using this metric to evaluate single stocks to pick up, if said stock doesn't have a PE ratio, then you can eliminate it from contention, so to speak. So PE ratios can be used in a forward or trailing manner. What do I mean by that? A trailing manner would be evaluating a company's past PE ratio, and a forward measured PE ratio will be measuring the ratio into the future using future earnings estimates, either provided by a company or looking at the last 2 quarters of earnings and estimating the next 2 quarters. Now, as you might imagine, there are many problems with both methodologies. Let's look at the problems with forward earning PE ratios first. Whenever it comes to estimates of any kind of metric, you're either taking estimates from the company itself or from other investors who are estimating what those earnings could be in the future. And that's fraught with all sorts of danger. For example, companies are always looking out for their best interest, just the same way you look out for your best interest. They're always going to put their best foot forward, so to speak. While it's good for them, it may not necessarily be good for you and your investment dollars. And if you don't go with the company's estimates, but instead with other investors' estimates or with other analysts' estimates, well, you're taking their biases into account as well. And no one has perfect 2020 vision on any of these things, particularly in the future. I'm saying all that to say, take forward-looking PE ratios with a grain of salt. Now that said, past PE ratios are not perfect metrics either, because as we all know, past performance is not indicative of future profits. So there are no perfect metrics, but price to earnings and price to earning growth can help you gauge if a company is overbought, underbought, overrated, or underrated. I should probably describe earnings per share a little bit as well. Earnings per share is calculated as the company's net profit divided by the outstanding shares of its common stock, where net profit is the money a company has left over after paying all expenses, where expenses can include cost of goods sold. Now, for operating other expenses, think of things like payroll and workers, leasing expenses, equipment and marketing, insurance, research and development, paper clips, things like that. Also, interest on outstanding debt, and of course, taxes. And another common metric for evaluating a stock is the price to sales ratio. Now, this is a ratio that compares a stock's price to its revenues. How is that different than price to earnings? Well, price to earnings ratios compare the stock price to a stock's earning per share, which is basically net profits per share. Price to sales ratios are straight stock prices to a company's revenues, or sales per share. The beautiful thing about all of these metrics is that they help to build on each other, and they can help inform you, the investor, about a company's health. After evaluating a company on each one, you will at the very least have knowledge about the health of the company and its short-term and long-term prospects, keeping in mind that anything can happen in the long term, but you know what kind of company you're dealing with. And that knowledge can help you judge if a company is overvalued or undervalued. Speaking of which, let's talk about which companies are currently looking overvalued. At this point in the market cycle, it could be quite a few of them. But for the sake of this video, we're going to focus on 2 examples, Tesla and Square. So let's start off with Tesla. So tech stocks have been the secret sauce of the stock market the last 5 years or so. No matter how much they run in the red, or how high their stock price is compared to their revenue, or other metrics that we talked about, investors love them and can't seem to get enough of them. Frankly, it's kind of reminiscent of the late 90s and the dot-com bubble. For those of you that were just weaned a couple weeks ago, when that particular bubble burst, a minor recession kicked off that everyone panicked about for a few months, like most people do with all recessions, whether or not they're minor or major. But back then, there really wasn't a whole lot of substance to the majority of the companies that people people were investing in, which is one of the main reasons why the bubble burst so violently. There were people that would literally set up a company and a website and then get listed on the stock market and kind of figure it out after that. Well, history has a way of repeating itself, and a lot of folks feel that we're in a very similar situation right now. Now, I don't know about that. In fact, nobody can know about that. Anybody trying to predict what the stock market, crypto, real estate, or whatever market will do next is really trying to shamelessly get clicks and views. Ahem. Nevertheless, it's starting to look that way with quite a few tech stocks: Shopify, Netflix, and of course Tesla. All these companies continue to gain ground, however. For example, Tesla was up 500% in 2020, and that presents a little bit of a dilemma. If you're not invested in these companies, you might be missing out on the gains. After all, the valuation of a company is driven a lot by investor sentiment. Investors who are trying to catch the wave of megatrends with the potential to literally transform the world in the coming decades. Being on the ground floor of that transformation is going to be very lucrative for whoever picks the right horse. And thus, in the minds of many investors, they're willing to pay up for that privilege. But what if some headwinds come around, such as changing regulatory environment, more competition from better positioned competitors, loss of appetite from customers, etc.? It happened to cryptocurrency, Bitcoin specifically, and it happened to any number of companies throughout the over 200 years of investing in stocks. Will those valuations hold, or will they crumble like a house of cards in a wind tunnel? That's when understanding the fundamentals of a stock comes in handy. For example, if you look at Tesla's price to earning ratio, trailing 12 months that is, of about $1,080, that means that an investor, in the hopes that Tesla is the company that will take them to the promised land of financial gains, is willing to part with $1,079 for $1 of earnings. Let's be real with each other. That's an absurdity, particularly with other car manufacturers like General Motors, Volkswagen, Toyota, and other brands coming out with fully electronic cars in the very near future. Will Tesla truly be able to compete and dominate that competition? Or will customers with different tastes go elsewhere? If they do, what will that mean for the stock price? It's likely going to crater. Tesla isn't the only tech stock that might be irrationally overvalued. There is the case of Square. Square is an interesting company. I saw one article where some investor compared owning Square today to owning a share of JP Morgan in 1871. Maybe, but in 1871, there wasn't a ton of competition for what Mr. Morgan was doing. Nowadays, there are several companies and even forms of technology that are competing for Square's market share. And certainly, none of them have a foothold the way Square does in today's commerce and e-commerce space. But that doesn't mean that that can't change in the near future. The company reported revenue of $9.5 billion in 2020, compared to $4.71 billion in 2019, which is impressive and should be noted. But if we look a little bit deeply, the company also had a declining profitability in 2020 of $213 million, compared with $375 million in 2019. How do you double your revenue and lose profitability? Easy enough. You have a spending problem. That problem, if not addressed or used appropriately, will be made painfully clear if rough waters come for Square, making its stock not as attractive to hold. Now, this is a lot of stuff to take in, a lot of analysis to know which companies to own and which to dump. There has to be a better way, right? Well, yeah. Learning all these ratios and all these metrics to distinguish which stocks to pick up and which to ditch can be quite a time-intensive hobby. In reality, it's a difficult job for many seasoned professionals. And what's worse, very few people who analyze and pick stocks for a living actually beat the S&P 500. And that's whether they use fundamental analysis, technical analysis, or some combination of the two. There are some out there who do it, by the way, but not a ton. Yet still, Standard & Poor's has been doing a study for 16 years, trying to determine if people who actively manage their investments beat the market. They found that after 10 years, 85% of actively managed large cap index funds underperform the S&P 500, and after 15 years, 92% underperform. That means that only the best of the best of the best active traders can actually beat an index, meaning if you know one of them, be sure to invest with them. You likely do not know one, however, and they're probably not on YouTube or TikTok or on the gram either. More than likely, they're in a hedge fund somewhere trading exotic instruments, getting their financial data in near real time, while the rest of us are waiting around on laggy 5G phones on apps trying to catch up. With that in mind, the best way to consistently grow your wealth long term is to invest in index funds that track major indices like the S&P 500. But that doesn't mean that you still can't follow along with your favorite analyst and determine if what they say makes sense, or is complete horse hockey. Speaking of which, subscribe to this channel with post notifications turned on, as that is one of our favorite topics to discuss and is in our wheelhouse. And if you're into that too, then we'll make a fine match. Also, if you get any value out of this video, then gently, tenderly, and lovingly smash that like button to stimulate that rhythm, you know, the YouTube algorithm, and drop us a comment with some stocks you think are overvalued and some that you think are undervalued. We're all dying to know what your thoughts are on the topic, so don't be shy. And remember, a goal without a plan is a wish. A goal with a plan and no action is a wish list. Thanks for watching, everybody, and I'll catch you next time. Peace.